Hey friends, I am back with another video. But first, as always, I am not a financial advisor. I'm assuming you're familiar with put credit spreads, or you can watch my part one beginner option strategy video where I introduce them. In this video, I'm going to be talking about delta. Delta is one of what are called the option Greeks. These are just pieces of the model used to predict the price of options under different conditions. In the case of delta, you're seeing how your P&L will respond to a move up or down in the underlying. To illustrate this, I'm going to show a put credit spread on Amazon. I have no opinion on Amazon. I'm just picking it at random. Here, we're looking at thinkorswim's Analyze feature. The light blue line is your P&L at expiration. That's usually the plot you see when people discuss put credit spreads. At expiration, anywhere above the 120 short put, you're in max profit. The purple line is the right now line. That is, at the current market price of Amazon, right now, the P&L is zero. That's what we would expect if we had just put this trade on. With the put credit spread, a move up is a move away from the risk. So as the insurer, we make a profit. Moves down towards the risk, increase the price of the insurance since the risk is greater. So a move down hurts us and our P&L is a loss. Put credit spreads benefit from moves up in the market, but they are also short options trades, and they also benefit from the passage of time. So as each week passes, if the market is still in the same place, there's less time for it to drop below that 120 level. So less time means less risk, and less risk means the options contract is cheaper. So that's another source of P&L for this trade. In options terminology, we call the right now line the T plus zero line. That is the current time plus 0 days. Thinkorswim lets us plot additional lines into the future, such as T plus 14, T plus 28, etc. This is what that looks like. So you can see that as time passes, if the market stays where it is, the trade still makes money. Okay, now back to delta. When you look at the P&L effect of a move up or down on the T plus zero, this can be characterized by how much the option spread price changes for a $1 move in the underlying. One delta means the position makes $1 P&L on a $1 move up in the stock. This will feel like owning one share of the stock. Here we have an 8.6 delta on Amazon. This will feel like owning 8.6 shares of a $127 stock, or roughly $1,000 worth of Amazon. The margin the broker will require is around the max loss of the spread, so $360. So it's important to be aware that if you trade these put credit spreads, that you can have a lot of leverage on if you aren't paying attention. Each option leg in a spread has its own delta. You can see this in the option chain, this here for Amazon. The delta for the spread is calculated by adding or subtracting each of these deltas up to get a net delta for the spread. That's the delta we were just looking at on the Analyze tab. So delta also has that 100 times multiplier for equity options. In Thinkorswim, the option chain here is showing decimal deltas, but on the Analyze tab, it's already applied the 100 times multiplier. So that's just something to be aware of in Thinkorswim. I should add there are other things that influence option prices like Vega. Vega is another Greek we will talk about later. All of these Greeks and Analyze plots are more like a weather forecast than an exact science. Okay, so that was a quick introduction to the first Greek, delta. This sets us up to talk about delta neutral strategies in the future. If you found this video helpful, please drop a like as it really helps the channel. Subscribe for more like this and more option strategies. See you there.